Hello. 2 weeks ago when we came, we forecast that equity markets should enter a period of correction. Now we can see why this correction has started with the trade war between the US and China, which has been reignited. In this video, we'll try to understand the consequences of this trade war on both equity markets. We first start with the graph of the S&P 500. This is an investor's view on our fingraphs.com platform, combining a weekly chart for the perspective over the next few quarters, a daily chart for the perspective over the next few months, and an hourly chart for the perspective over the next few weeks. For now, we believe the S&P 500 is still in an uptrend. It is in a bit of an exaggeration. You could see that our impulsive targets to the upside have been reached, that both our envelopes are touching each other, and that our risk index is back in the overbought zone. This means that the progression from here on, possibly into the summer, is going to be slightly more difficult. Looking at the daily graph or the perspective over the next few months, the S&P 500 is still heading up. Our targets suggest that it could make it back above previous highs and possibly up to the 3,100 levels. So some potential left over the next few months on the S&P 500. That said, in the short term, we could see that our risk index is in very much of an exaggeration. It is overbought, and that our envelopes are touching each other, so that the current correction doesn't really come as a surprise. It may lead us down over the next few weeks until it finds a base to move higher, probably towards the end of May, and then up into the summer. In the meantime, the hourly chart is heading down, and we'll have a closer look at it on this zoom chart. What we can see is that our potential to the downside still leads us to perhaps another 1.5% to 2%, 2.5% of downside potential into the low 2800s, possibly into the high 2700s, and this potentially over the next 1 to 2 weeks. Our risk index is already oversold and may bounce at some point, but we believe that the downside momentum is still there, and we would stick for now to our targets to the downside. We do believe that this whole correction move down is an intermediate correction, and that once we get into this zone, this could be an interesting buy the dips opportunity to move higher into the summer. We now turn to the Chinese market. The difference here is that the weekly graph is still in a long-term downtrend from its mid-2015 highs. We can see that this downtrend doesn't seem quite over yet and would suggest further potential to the downside, possibly towards the end of the year. Our targets to the downside have not been fully completed yet. We can see that we've reached their lower end, but the higher end, sorry, but the lower end still leads us below 2,000, and this possibly towards year end. We do, however, see an important intermediate low that was done late last year, with our risk index well in the oversold situation and our envelopes touching each other. The bounce which has followed has also been very strong. The question here is that do we see this bounce continuing, possibly into the summer as with US markets, or would we expect a more deceiving performance for the Chinese index, possibly gradually resuming its downtrend to go reach these targets towards year end and possibly early next year? What we could say when we look at the daily graph is that for now, the uptrend still seems to be in place, yet that the correction that we've seen over the last few weeks is very compelling. We wouldn't want this correction to continue to slide, as it is starting to reverse most of the strong move and momentum higher we've seen since the beginning of the year. So the question mark here is that can we actually, as in the US, find a low and find a dip where we could see an opportunity to resume the uptrend into the summer, or are we going to keep sliding lower, or at least sideways, and that the Chinese strength, or relative strength versus the rest of the world, could possibly have already come to an end. Shorter term, we look at the hourly chart, which we're also going to zoom in here. what we could see is that the downtrend started early April in China. It does seem that it is coming to an end. However, the volatility of the Chinese market is potentially 3 times as high as in the US, which means that this last move down could be stronger than the move down we anticipate on the S&P 500. We calculate that our targets could lead us another 2 to 4% lower. So still on a relative strength basis, China, because of its volatility, could continue to underperform the US over the next few weeks. Now we look at the longer-term picture of this relative graph of the Shanghai Composite versus the S&P 500. We can see that for now, the downtrend of the Chinese market is still in place, and that it may continue possibly towards the end of the year, and that the potential to the downside is still relatively compelling. At the moment, we are about at 60% from the 100 mark that started at the beginning of the chart, and we could still make it lower down to the 40% of that 100% that we saw at the beginning of the chart. The risk index is quite low, but is not quite oversold yet. So yes, there is potential for further Chinese underperformance during 2019, as was the case in 2018. So the recent reignition of the trade war does bring back difficult memories from last year. And as far as we could conclude from the weekly graph, the possibility of further Chinese underperformance is a reality. Shorter term, we look at the ASHR tracker, which tracks the CSI 300 China Asia Index versus the S&P 500. We could see that following a strong bounce from last year, the reversal has been equally strong, and that we are now approaching our corrective targets to the downside. Here we could see that this correction could probably last another month or so, and provided it doesn't break below our corrective targets to the downside, attempt to resume its uptrend. That said, the exaggerations we saw last month, meaning our envelopes were touching each other, our risk index was very much in the overbought zone, seem to imply that there is a risk that we continue to move lower below these corrective targets. And so for now, we would be quite cautious on calling any relative outperformance of China versus the US. We think that this move that we saw since last October may have been a strong correction that is now reversing down. Another argument we would bring for this Chinese underperformance, US outperformance, is that very often Chinese markets do move with the US dollar Chinese yuan FX pair. It is often a question of flows and of capital flights out of China when the equity markets are having problems over there. What we could see is that the dollar remains very, very strong. It is still in an uptrend following a strong correction down in 2017, a huge rally in 2018, a slight correction since the beginning of the year, and we believe now that it could resume its uptrend, possibly over the 7 mark into later on this year. We can see that its strength since the beginning of the year has now paused, and the dollar is back in an uptrend versus the yuan. The risk index was quite low and is reversing up, and we would expect this to be quite a strong resume uptrend situation into the summer. Shorter term, we could see on the hourly graph that the breakout is starting to happen. We've seen a very strong acceleration since the trade talks broke down a few weeks back, and this acceleration doesn't seem over yet. So to summarize, we believe that the trade war being reignited between the US and China is probably going to be defavourable to China, and that the US, according to our graphs, should probably outperform Chinese markets until at least the summer. Thank you very much and have a good week.